Are you thinking of selling your investment property? Do you know what a portion of tax or capital gains will apply? Investment properties, rental properties, cottages, land, all are related to where you have to pay capital gains. We've been helping thousands of clients buying, selling, and investing for the past 30 years. We are the Jom Joseph team. My name is Jom Joseph. I'm the broker.
My name is Jom Joseph. I'm a real estate broker and a mortgage agent.
Hi, I'm Jessenia. I'm a real estate agent and the admin and marketing coordinator.
I'm Cicy, the realtor with the team. So now what is capital gain? A capital gain happens only when you sell an investment like real estate, and only when it is sold more than what you bought for. A simple example is, if you bought a property for 500,000 and you're selling it for 700,000, your capital gain is 200,000. And this happens only when you sell the property. If not, then it is just sitting there.
Yeah, and when you look at the capital gains for that 200,000 example that Cicy was talking about, only 50% of that is taxable. So out of the 200, only 100,000. Now that 100,000 is taxable based on your tax rate. So if you are only on a 50% tax rate, you'll be taxed only 50,000. But if you're only on the 15% tax rate, you'll be charged only $7,500, right? So that's the calculation on the capital gains.
So do you pay capital gains on all the properties?
Not really. If you own a principal residence, basically you're exempted from the capital gain taxes on a principal residence. However, if you own a investment property, say cottage or rental properties or land, you might be end up in paying capital gain taxes when you sell it and if you make a profit on it. And also, most of the investors doesn't realize that if you own a collectibles or artwork or jewelry, you may owe capital gain taxes if you make a profit more than $1,000 when you sell it.
I'm sure most of the people are not knowing that.
Yes. If you sell it, if you make profit, you to CRA.
So in Canada, only a portion of your capital gains is taxable.
Is the new rule coming into effect about the capital gains?
So the government was actually planning on implementing it earlier this year, where they wanted to do that 66.67% was taxable on any amounts over 250,000, but they have since gotten rid of that.
Okay.
So as of right now, only 50% of your capital gain will be taxable.
So that is including the corporation, individuals, and everyone?
Yeah, corporations, individuals, and trusts.
Okay.
Yeah, I mean, I think with that rate that they were going to actually increase, we had one of our clients who were thinking of selling their investment properties, I think 2 years ago.
Yeah.
And then this law, they were actually planning to make it law of increasing it. Then he said, let me hold off. And then he may plan to sell it next year or this year.
Which is good.
Which is good because then he was going to use that money for the retirement, right?
Yeah.
I think we had clients before who actually sold the investment property and they actually used it for their kids' education.
Yeah, that's right.
So there are different ways you can actually do that. Now, with the capital gains tax, you can also save the capital gains tax by reducing it with capital losses that you can carry forward from previous years.
How can you explain a little bit on that?
Yeah, so what happens, so say for example, you actually sold a property like maybe 5 years or maybe 3 years ago, and then you had a loss on that. Then you can take that loss and use it against this gain. So if say for example, your gain was 100,000 and the loss was 50,000, then only 50,000 is taxable, right? And also what is advantageous, principal residences are not taxable, which is a great thing for you to do, to buy a principal residence, because if you sell it after so many years, then there's no tax. In our example where we had a lot of sellers buy principal residence over 10, 15 years, their property value has doubled or tripled. So if they sell it, that's a huge gain that they can use for retirement, travel, or any other things that they want to use.
That's correct.
And then there's also another exemption where you can actually write off all your expenses against your principal, not principal residence, but your rental gain as capital gain. And then also tax planning is key so that you know when to, sell, when to buy. So that way you can save less, pay less taxes and actually gain more profit. Now, we've been helping sellers, buyers, and investors for the past 30 years. Call us, email us, or click on the link below, and we can guide you through the process.